Hi guys, how's it going? It's Alright, I'm checking. Welcome back to my YouTube channel. Today we'll be doing a portfolio update. Those who watched my previous video know that I sold my shares in Pick n Pay because the company cut dividends and is technically insolvent. So when a company is insolvent, their assets are way less than their liabilities, right? And such company actually is in a very shaky position financially. As for somebody who invests for dividends, it does not make sense for me to stay invested in a company that is proving to not afford to pay dividends, right? And I did say that it was going to be a whole situation if maybe they say they are cutting dividends because they want to take that money and invest back into the business to expand the business. And if you think about it, when a company expands their operations or their business, they're going to make more money and they will afford to pay dividends, right? So with this one, it's a bit of a different situation because they are not paying dividends because they do not afford to pay dividends, and it's because they are making losses, right? So for me, I just felt like as a dividend investor, I'm going to take my money out of this company because at this very moment, they are not helping me meet my investing objectives, which is to get dividends or to make passive income. So I bought another company to replace Pick n Pay, and I bought a dividend paying company. So let's look into it and also look at my overall performance portfolio in my Easyequities ZAR account because that is where all my individual companies are at. So let's get into it. I have 11,600 rands invested and my portfolio is currently down 0.06%. And scrolling down there, you see the allocation. I have 68.93% in individual companies and 31% in ETFs. And the ETF that I have is actually for growth, not for dividends. This is the One Invest S&P 500 Infotech. I have 3.6 invested and is currently down 3.67%. And the next holding I have is Exxaro. I bought Exxaro to replace Pick n Pay, right? And actually I was intentional about going for this company because number one, it's in the top 40 and it's actually a good company and it's doing well financially. And looking at its dividend history, they've been paying dividends for over 21 years now. Consistently, they've never cut dividends. But I just thought, let me put my money into this company because it pays dividends. It has a high dividend yield of above 10%. It is quite high actually, but I was okay with going with it. And looking at their finances, they're actually doing so well. They're profitable, they have a positive cash flow, and they have way more in equity. This just means that their assets are way more than their liabilities, right? So looking at their finances, they're actually doing well. They have a very strong balance sheet, and for me, that is the number one thing that I look at when I buy a company. So given the dividend history and looking at how their finances are, it just made sense for me to go for this company. And like I say, I was intentional about it because I wanted to buy a company that is more established. So I had to look for one in the top 40 and I went with it. So currently this company is up 0.23%. And I also have Thungela, and Thungela and this company, they're actually in the same industry, right? And Thungela, I'm down 20.92%. That is a huge loss. But anyway, I'm not going to cut my losses in Thungela because I'm also investing in it for dividends. So looking at how the mining industry is actually taking a beating, I looked at Exxaro's financial results. They were published just a few months ago, and it's losses. Like there's a decline in revenue, decline in earnings, and when you look at that company and you compare it to their peers, you actually see that it's an industry problem, right? It's not just a specific company problem like Pick n Pay. If you look at the industry, the supermarket industry in South Africa is not doing so bad. The ShopRites, Pick n Pay, Woolworths, they're doing so well. And then there is Pick n Pay that is having a problem, and that is internal problem, right? So when a company is actually being affected by its internal factors, for me it's a cut. But when a company is being affected by external factors, for me it's a thing of, okay, they don't really have that much of a control over these factors, so it's okay. So I am okay with having Thungela and Exxaro. Even though they're in the same industry, I am very much okay with them. So it kind of makes sense why Thungela is actually down 0.92%. I did a video on Thungela just looking at their results, I think sometime last year. So I know that what is affecting this company is also what is affecting Exxaro. So I am very much okay with buying Exxaro even though they have reported losses for their past 6 months. And the next company I have is FirstRand. It's up 16.28%. This is too much. This is for the first time ever. Actually, my portfolio is looking like this. Premier Group is up 13.58. Storage is up 5.53, right? So FirstRand has a dividend yield of almost 6%. And I am okay with it being at 6%, in as much as I am looking for companies that is going to pay me a high in dividends. I have to be smart about it, because when I go for companies that only have dividend yields of above 9 or 10%, it's going to be a bit of a problem, because then the overall performance of my portfolio is going to be affected, right? So having companies in your portfolio that have a dividend yield of less than 7% is going to actually help the growth of your portfolio. So I am okay with having FirstRand at roughly 6% dividend yield, and it's in the banking sector. So just when I look at my portfolio, I see that there's a bit of diversification. There is mining, there is banking, and food. Premier Group is in the food industry, and storage is the property industry, right? So not too diversified, but I am okay with this diversification now. So Premier Group is up 13.58%. They've recently reported their earnings and its growth everywhere, right? And I bought this company last year knowing very well that they're going to pay dividends because they announced so. So they kept their promise. They declared a dividend of R2.20, which is 3.3% dividend yield. So I am okay with it at 3%, because I know that I'm not going to get more in dividends, I'm going to get more in growth. And that is my plan, actually, that I'm not going to buy companies that have a dividend yield of above 9%, because like I say, it's going to affect my overall performance portfolio. So I'm going to continue building my holding in Premier Group. I won't be selling it unless they cut their dividends for insolvency reasons, right? So I am okay with keeping it. And there is storage. This one obviously I'm not going to be selling, because it's a property company and most of them have high dividend yields. Currently, storage has a dividend yield of 9%, and I am very much okay with it. And then there's Thungela that I have touched on when I was talking about Exxaro. So yeah, guys, that is my portfolio, my Easyequities ZAR portfolio, and how it's looking like. And I don't have a lot of money invested in this account, simply because I am investing heavily in the TFSA. I split my contributions, right? 75% goes to my TFSA and 25% goes to my Easyequities ZAR account. That is why I only have 11,600 invested in this account. But looking at how things might unfold, I'll be mixing out my TFSA quite soon. So over time, actually, if you really think about it, my investment in this account is going to be more than my investments in the TFSA, simply because the TFSA is kept. I cannot invest more than 36,000 in a year. So once I mix it out, then I'm going to invest more into this account. But for now, I'm going to continue to do the 25-75 split, and that's how it's going to be until I max out my TFSA. And I'm actually looking to add more stocks, because currently I don't have any company that is paying me dividends on June and December. So I'm in a search of a company that is going to pay me dividends in December and June, but at the same time it must have a dividend yield of 8% and less. I'm no longer going for high dividend yields, because I'm just trying to be, like less aggressive with my strategy, the dividend investing strategy. So I'm currently looking for a company that is going to pay me dividends in June and December, but has a dividend yield of less than 8%. It's a lot of work to find a company, actually. Like, to find a quality company. I mean, it's easy to just decide that we're going to buy this company without considering a lot of factors. But for me, I like to keep it safe. I want to invest in companies that I know that they are well financially and they will continue to pay dividends because they're in a good financial position, right? So for me to find these companies, it takes time because I'll be doing my homework, right? And doing your research actually in any company, it's a lot of work. But once I find that company, I'll obviously be adding it to my portfolio. So yeah, guys, it's a wrap on my dividend portfolio update video. Thank you so much for watching. I will see you in my next video. Don't forget to click that like button, comment and subscribe, and enable notification bells so you get notified whenever I upload a video. See you next time. Bye.